So now that we've seen how this framework can actually work, I think what is amazing and impressive is to see how it can be applied in almost any of the major financial crises we've seen in recent years. So if you looked, for example, at the financial crisis in Mexico, 1994, this is the famous tequila crisis, where Mexico had a massive financial crisis and then it began affecting other countries. You see, there was a contagion effect. What is interesting to notice about this is that in the case of Mexico, every single one of the indicators, and I'm now going to use my little pen to just circle them. It's hard to see in the yellow, so I may want to use a different color because what I think is impressive is to notice that in the case of Mexico in 1994, every one of these indicators was red. If we had had this little chart, we had laminated this, put this in plastic, and held it in our pocket and pulled it out in 1994 in Mexico, we would have said, of course, Mexico is going to have a balance of payments crisis. Of course, that is likely to be followed by a massive devaluation of the Mexican peso because every one of these indicators is red. And so what had happened is Mexico had pegged its peso to the US dollar. So it had a fixed or pegged exchange rate. The size of the current account deficit was very large, well over 5% of GDP. The size of the budget deficit also was very large. The Mexican government, the ruling party was hoping to win re-election, was making sure that its hand-selected candidate would win re-election, was spending lots of money to make sure that people were happy and things were going well. And there was a lot of public expenditure, so there was a large budget deficit. And so the problem is that Mexico had basically one of the things it was doing to finance these deficits, the current account deficit and the budget deficit, is it was financing that by selling government bonds. And the government bonds it sold primarily to the United States were very risky, right? And investors increasingly began to notice this and to notice the size of the Mexican foreign debt. They noticed the size of the current account deficit and the budget deficit, and they were maybe a little bit nervous. But when the leading presidential candidate from the ruling party was assassinated on a campaign stop to Tijuana, someone jumped out and shot him in the head, then investors got very nervous. There also was some political unrest in southern Mexico. There was an uprising in the southern state of Chiapas. And so investors were very spooked by some of these things. They were concerned, and they began to sell those Mexican government bonds very quickly. The Mexican government did not have sufficient reserves of US dollars in its central bank to buy up all this excess pesos, and eventually they had to let the currency collapse. And so you see all of these indicators, small amount of foreign reserves, large amount of foreign debt, large budget and current account deficits, and all of this combined with, high level of political risk, that was it. And so all of those indicators being red forced investors to recognize it was time to sell the Mexican government bonds, and they sold those government bonds. They got lots of Mexican pesos in return. They sold those pesos, and that flooded the market with Mexican pesos. The central government, the central bank, did not have enough US dollars in reserve to buy up the excess pesos. The result was a massive devaluation of the currency. And so that in turn set off a massive contagion effect throughout Latin America. As investors said, wait a minute, if that could happen in Mexico, maybe it could happen in other countries. And they began to sell off government bonds in those other countries too. And so you started to see this sort of, they called it the tequila effect, because, if you drink a lot of tequila, you get a little tipsy, right? You get a little wobbly. And so that's what began to happen to all of the currency markets and especially even the stock markets of other Latin American countries. That contagion effect spread as investors pulled their assets out of other Latin American countries, and that really had a negative impact. So that became known as the tequila effect. But in general, this kind of phenomenon, of course, as we know, is called the contagion effect. So if we see this happen again in a place like South Korea, we'll talk about this more in depth because this is such a classic case of a balance of payments crisis, of investors losing confidence, the crisis of confidence, and all of those kinds of things. We'll talk about that in more depth. But a similar kind of thing happened in Argentina. And Argentina had pegged its currency to the US dollar. The currency was not flexible or floating. It was rigidly fixed to the US dollar. And so that meant that as the US dollar got stronger and stronger, so did the Argentine peso. And so what happened is over time, it became more and more difficult for Argentine companies to export their products. And as a result, what do you know? There was a large current account deficit. The currency was overvalued. It no longer reflected the true value of Argentina's products and services. And so that current account deficit was virtually inevitable. There was also a large budget deficit. Argentina was paying lots of money to the provincial governments, was spending lots of money on various kinds of things, was not bringing in sufficient tax revenues to cover those expenditures. And so what you had was the Argentine government, selling lots of government bonds to foreign investors to cover the budget deficit, also selling lots of foreign government bonds to foreign investors to cover the current account deficit. And these twin deficits being financed by selling government bonds to foreign investors meant the foreign debt got bigger and bigger and bigger. So as you start to see what's going on here, you see that in Argentina, all of the indicators in 2002 also were red. And of course, there was a contagion effect. Now, Brazil had already had a massive currency devaluation of its own in 1999. And so Argentina, as Brazil's largest trading partner, was very severely affected by that. Brazil, with its massive currency devaluation, was able to export its products to Argentina at very low prices. And so it became very easy for consumers in Argentina to buy consumer products. And so up until 2002, that's what they were doing. They were buying imported consumer products from Brazil. And that resulted in a huge current account deficit, you can imagine. And so investors increasingly were saying, well, if there was a crisis in Brazil, now we could see a crisis in a neighboring country. Which country would be most adversely affected by that? Which country seems to be being affected by this the most? And of course, that was Argentina. And so it's no wonder that this contagion effect contributed to the massive currency devaluation in Argentina. So this chart actually works, right? It predicts these kinds of crises. Now, in the case of Greece in 2012, Greece, its currency was no longer pegged to some other country's currency. Greece had actually adopted the euro. It had abandoned its own weaker currency, the drachma, long before, and it had decided to adopt the euro and become part of the eurozone. But of course, what that meant was that now what happened in Greece's currency reflected what was going on in the stronger countries like Germany and France that were part of the eurozone as well. And so what you saw was that Greece's economy was not that competitive at that very high, basically, valuation for the currency, the euro. And it was very difficult for Greece to export its products and services, right? Especially as its tourism services. People said, well, it's very expensive to travel in Greece. We have to use euros. You need a lot of euros to pay for these things in Greece. And so it was very increasingly this essentially not a fixed exchange rate, but the fact that Greece was on the euro meant that its current account deficit got very large. And it was importing more than it was exporting. And it was financing that current account deficit by selling government bonds to foreign investors. So the foreign debt got bigger and bigger and bigger. At the same time, Greece had a very large budget deficit as well, which it was financing by selling government bonds. So it's no wonder, right, with these twin deficits, that Greece would also experience a financial crisis. Now, Greece did not have, the luxury of experiencing a massive devaluation. It was rigidly fixed on this euro, right? It was on the euro itself. That was Greece's currency. And so there could not be a devaluation, but Greece did experience a terrible financial crisis. Investors did pull their assets out of Greece. There wasn't a devaluation, but this sort of thing was very devastating, of course, for Greece's economy. Greece is still trying to recover from that terrible financial crisis. And again, a lot of these indicators, this could have been predicted. And of course, what happened in Greece then set off a contagion effect in other European countries as investors said, well, wait a minute, if something like that could happen in Greece, maybe there could be a terrible crisis in Portugal or in Spain. And they began to pull their assets out of those countries. Those countries, of course, then began to experience similar kinds of problems. So I think what you're seeing is that this chart, these indicators, are very useful at predicting these kinds of crises. And often, not in the case of Greece, of course, since it was stuck on the euro, but in other countries that have decided to peg their currency to some other country's strong currency, you can often see this sort of problem happening. And you can predict when a crisis like this is likely to happen. This can actually give you advance notice, potentially, of a massive currency devaluation. And that might be very useful to you as an international manager. It might let you say, well, given the kind of risky indicators we're seeing, it might not be the best time to start exporting our products from the United States, for example, to that country. That country could be on the brink of a big financial crisis, possibly followed by a massive currency devaluation. It could also alert you to the possibility that, hey, if this country is ready to experience a financial crisis, the time to invest in that country might not be right now. Let's wait until the crisis happens. Let's wait until the big currency devaluation occurs. Then we can swoop in and perhaps invest at a lower rate. Our money will go farther. Our US dollars, for example, would go much further in Argentina after the massive currency devaluation. And so that might be another reason these kinds of charts could be useful. I recall one of my students, right when the massive currency devaluation happened in Argentina in 2002, this was one of my graduate students at Thunderbird. He happened to have $50,000 sitting in his bank account in cash, and he was able to go and buy a beautiful apartment right in downtown Buenos Aires for $50,000 cash. Now, that apartment is worth almost $1 million now. So there are opportunities when these things happen, and it's useful. This kind of framework, I think, can give you an opportunity to see how you can actually make sense of this, predict these kinds of things before they happen, avoid potential problems, and possibly even take advantage of some interesting opportunities. That's why this is a useful framework.